Meet Balance Sheet, the financial snapshot. Let's talk about money. Not just spending it, but understanding where it lives in a company. Think of a company like your own house. It's full of valuable stuff, right? That's what we call assets. Now imagine you bought some of that stuff with borrowed money. Those are liabilities. The part you own free and clear, that's your equity. See, owning a house is like running a business. We track all of this in a financial statement called the balance sheet. It's a snapshot of a company's financial health at a specific moment. It tells you what the company owns, assets, what it owes, liabilities, and what's left over for the owners, equity. The balance sheet is your starting point. It's the foundation for understanding a company's financial position, but it's just the beginning of our journey.
Now imagine you're running that house like a business. You're renting out rooms, maybe even baking cookies to sell. That's revenue coming in. But running a house or a company costs money. Groceries, utilities, maybe even cookie ingredients. Those are expenses. The income statement tells the story of a company's operations over a period of time, like a month or a year. It tracks all the money coming in, revenues, and all the money going out, expenses. The difference? That's the profit or loss. The income statement shows you how profitable a company is. And guess what? This directly impacts the balance sheet. More profit? That usually means more assets or less debt. Losses? Well, that can go the other way.
Having profit is great, but can you pay your bills? That's where cash flow comes in. Think of it as the lifeblood of a company. You can be profitable on paper, but still run out of cash if you aren't careful. The statement of cash flows tracks the movement of cash both in and out of a company. It tells you where the cash came from, how it was used, and how much is left. This is crucial for understanding a company's liquidity or its ability to meet short-term obligations. The statement of cash flows is directly linked to both the balance sheet and income statement. It shows how cash is generated from operations, income statement, and how it's used to buy assets or pay down debt, balance sheet.
Section 4. Retained earnings, the bridge between two worlds. Remember the income statement story about profits? Well, what happens to those profits? Some might be paid out to owners as dividends, but the rest? They stay in the company as retained earnings. Retained earnings represent the accumulated profits of a company that have not been distributed as dividends. It's a key link between the income statement and the balance sheet. Think of retained earnings as a savings account for the company. It reflects the company's overall profitability over time and can be used for various purposes, like reinvesting in the business, paying down debt, or even buying back stock.
Section 5. Managerial accounting, the strategist behind the scenes. So far, we've met the key financial statements, but who uses this information? Enter managerial accounting. Think of it as the internal financial strategy team of a company. Managerial accountants use financial data to help make better decisions. They create budgets, analyze costs, and forecast future performance. This helps management make strategic decisions about pricing, product development, and overall business strategy. Managerial accounting leverages the information from financial statements, digging deeper into the numbers to provide insights and support decision-making. It's about using financial information to drive the business forward.
Section 6. The Financial Avengers assemble. A critical decision looms. Our financial superheroes, the balance sheet, income statement, statement of cash flows, and retained earnings, have assembled, giving us a complete picture of the company's financial health. But now, a critical decision needs to be made. The company has an opportunity for expansion, a chance to open a new facility and tap into a new market. It's a big step, one that could bring significant growth, but it also requires a substantial investment.
The CEO calls a meeting. We need to carefully consider this, he says, spreading out the financial statements on the table. This decision will impact every aspect of our business. The room falls silent. The fate of the company hangs in the balance.